I want to thank you for attending this session in our webinar series at Cash Flow Champs today. As always, it's our intention to bring you good content on a weekly basis, to develop good relationships with you, and also to be a resource for you in the multifamily real estate space. Now, today we'll be covering the topic structuring an apartment syndication deal. So in this webinar, we will cover just the correct entities for the apartment syndication. We'll also talk about preferred return on equity split, how that works in your structuring, hurdles, waterfall as well, and how it have impact on the returns for the investors, and also touch on investment fee structure. So it's a lot to cover. Of course, each one of these can be its own topic per se, but we'll just give a general overview of it and how it falls into the structuring. I'll take a minute or so to introduce myself for those who don't know me. I'm Paul Sr. I'm one of the managing partners at Cash Flow Champs, and I'm married. I live outside Washington, D.C. with my wife and 3 children. And not to bore you, I'll just send you to our website in terms of finding more information out about myself and our other partners at Cash Flow Champs. So when you go to cashflowchamps.com, just hover over the About Us button, and you can click on that, and then you can get some more information about us there. I'm also the co-host of the Cash Flow Champs Real Estate Podcast with my partner, Prashant Kumar. So you can hear that here once a week. We also give good content there as well. The whole objective is just to keep you informed. Our team portfolio right now is about $146 million, and just added to that yesterday. Went to close in on one of our biggest assets to date yesterday, 236 unit in the Atlanta MSA. And we're very excited about that and the opportunity that will bring for our investors. We have some resources for you. One of the free resources we offer to the public is the Cash Flow Champs underwriting sessions on Saturdays at 4 p.m. So you can always take advantage of those. Those are free sessions that our managing partner, Charles Steven, he goes over those, and you can just click on the QR code that you see on your screen, and you can get some more information on that. We also have a paid program called the Aristocrat Coaching Program, and some of our students were actually in the deal that we did yesterday. One of the things that we promised our students when they join the Aristocrat Coaching Program, which is a coaching program of Cash Flow Champs, is that they will close the deal with us. And so even though it's a paid 12-month program, if it takes longer for them to close the deal, we hang on there with them, because our objective is to teach folks how to do this. Some people want to scale up from a few hundred units to thousands of units, and some are just getting started, right? So if you're just getting started as well, you're also welcome to do that. You can find people in the Cash Flow Aristocrat Coaching Program that you can collaborate with and get your business going. The Cash Flow Champs also offer a free summit, and we'll have it this year as well in November 17, 18 to 19. So if you go to cfcsummit.com, you can find some more information on us. So that's some of the resources that we offer for you. One disclaimer that I have to make here is that I'm not a real estate. I'm not a professional in terms of an attorney or a financial advisor or a tax advisor. The information that we're going to share with you today is just for informational purposes. So you want to seek the advice of the appropriate personnel if you want to kind of get any advice in those areas. So it's going to be a good one today. I'm going to jump in real quick. Won't be a long one. I will try to keep it about the 35 minutes mark. And if you have any questions, again, put those in the chat, and we'll definitely address those questions as we go through, and also at the end of the session as well. So we're talking about the correct entities that you should use for your apartment syndication. Let's jump in on that first in terms of the entities. So what kind of entities should you set up when you're structuring a multifamily syndication deal? Well, there are many entities to choose from, right? You have LLCs that are taxed as S Corp or C Corp. You have LPs. You also have partnerships. And so there's a variety of things that you can choose from in terms of setting up the structuring of your multifamily syndication. We use the LLCs to operate our business, right? So at Cash Flow Champs, we will set up one or a property LLC, and we normally set it up in the state that the property is located. Some lenders, however, will have some stipulation, and they may request another state. Typically, they'll request Delaware. Sometimes they'll request Wyoming. Normally, when you're dealing with bigger loan amounts, maybe north of $30 million typically, you will see lenders requesting that the buyers form their entity in Delaware. Delaware obviously is more business friendly and offers probably more protection for the lenders, maybe a variety of more reasons why they do that. But certainly Delaware is the go-to for assets that are typically north of $30 million. So there are a few LLC that has to be formed when you are structuring the apartment syndication deal, right? So when we talk about the LLC that is property specific, it's specific to the property. That is the LLC that's going to actually hold the property in it. You're also going to have a partner LLC, right? So for the partners that are in the deal, the GP partners, they will actually be forming an LLC as well. And it depends on what you're doing. It may be that you're JVing with another group, or you may be JVing with some type of an equity firm. Then you also secure also a JV LLC. So remember that these syndications, you will have a GP side to it, and you have an LP side to it, to the transaction. So you will have respective LLCs that is set up for each. So you will have the property LLC that holds the property. You also have the GP LLC, and you also have the LP LLC. So there are a variety of LLCs. So if we kind of take a look at this here, you'll see that normally you have investor entity, and that's the one we talk about, which is the borrower or the title holding entity. That is the entity that actually holds the property and holds title to the property. Then you will have an LLC, in this case, Class A, which is your investor LLC. Those are the ones investors that are investing into your investment as an LP. And then you will have the operators or the syndicators of the deal, which is mostly Class B, and that will be like your management, or really those are you earn your stripes here by your sweat equity, right? You're putting the deals together, and so you will have ownership interest in the LLC as well. Typically, the Class B is 30%, and the Class A is 70%, but that can be structured differently. Again, that can change, just depends on, and it could be 80-20, could be a variety of different ways, just depend on the operator. You need to know that as a passive investor, what you're getting into. The management LLC, we won't talk too much about that as well, but that certainly earns a fee from the investor LLC. And, you have to pay the management fee on an ongoing basis. And typically you pay 1 to 2% of that out of the EGI, which is effective gross income, right? So that's kind of, how that would be structured. Now, let's talk a little bit about equity split and the preferred return as it pertains to the multifamily syndication, right? Which is the second bullet on your screen. Now, this is important if you're a passive investor. As a passive investor, you want to know these terminologies, what they mean, and typically how they apply in terms of the deal that you're getting into. So what is the preferred return? Well, this is the minimum return that the investor must achieve. This is the minimum return the investment itself must achieve if the investor is going to get paid before the general partner. Let me put it another way. This is the minimum return that the investment must achieve so that the investors get paid before the general partner does, or the managers get part of the profits. So let's look at an example. If you have like a 7% preferred return, what does that really mean? It means that the preferred investors will first receive the first 7% of cash flow that comes off the deal, right? So of course, all the operating expenses must be taken care of first. So in terms of contract services or your general admin or, insurance and legal and things like that, all those are operating expenses must be addressed from the monies that are coming in for the deal. And of course, also your debt service as well, right? You have to pay the lender. So once those are taken care of, the operating expenses and your debt service, then you will have your cash flow coming out. The first 7% of that cash flow will go to the passive investors, and that's what the preferred return means there. So preferred return typically is within the range of, say, 7 to 10%, right? And you can have a dual tier structure as well. And in these deals, based on how you structure them, you can have a 7% preferred return with an upside and in the same deal that could be classified as a Class B. And you can also in the same deal just have a 10% straight preferred return with no upside, which is probably considered a Class A. And by upside, we mean that the investors will take part in the proceeds from the sale, right? So you can structure your deal such that some investors get a preferred return and they also partake in the upside. And then you can structure it where also you have a higher preferred return and those investors do not take part in the proceeds of the sale. They're more interested in a bigger ongoing cash flow from the deal. So for some investors, the preferred return is a requirement, right? You can also structure a deal without a preferred return, right? But some investors, include myself, I think that the preferred return is an important piece of it. If there is no preferred return, maybe the deal is a no-go, right? Because the preferred return, I mean, I think is a good way to compensate the investors for putting their hard-earned money on the line with you as an operator. Without the passive investors, maybe this deal wouldn't have gone. You do need the equity to close. So why not treat them preferentially, right? Have them get the first set of cash flow off the deal. Again, it's everybody's preference. You can go a straight split in terms of the cash flow that comes up, and we'll talk about that just a little bit. Now, the preferred return can be cumulative and it can be non-cumulative, right? So what does that mean? It means that if you have a preferred return that's cumulative, then when the money comes in, if there's a short on it, it carries on to the next year, right? Let's give an example. So if you invest in a deal with a preferred return of say 7%, and the cash flow for one particular year, say this year, couldn't produce more than a 5%, right? Then it means that there's a shortfall of 2%. So when you go to next year, instead of you having a 7% return, you now should have what, a 9% return, right? So that means it's cumulative. It's carried from year to year. If the required preferred return is not met for any given year. Now, if you have a non-cumulative preferred return, then it does not carry, right? If it doesn't make the cut that year, then you just take the loss and you always at the preferred return that you initially signed up for. So if you got a 5% preferred return that comes in for a particular year, when you go to next year, it doesn't carry at all. You just still remain at 7%. So you have to kind of know how the deals are structured, and we're bringing this to light to you so that you kind of investigate the deals that you're getting into and just be informed about this, right? Some preferred return also not only cumulative, but they're cumulative and compounding, right? So this preferred return is always optimal for the investor's economics. So not only are you carrying the deficiency from one year to the next, meaning that if it was 5 and you get the following year, you get 9, not only that, but you're also adding an interest rate at the 7% to that money that's carried over, right? That's the optimal thing for the investors. Not a lot of operators do that. That can be very challenging, but that's an option. Let's talk about the equity split for a little bit here. Now, for the equity split, cash flow champs normally do a 70-30 split for investments, at least this current time. Now, this equity split can vary, right? You can have a 80-20 split, you can have a 75-25 split, you can have a 60-40 split. And what that means is that 70-30 split just means that 70% of the cash above the preferred return goes to the LP, like we made mention, and 30% goes to the GP for their sweat equity. So the 70-30 split is the most popular that I see amongst operators in the space that we're in. And we have a deal right now that has that very similar structure that you can participate in. So if you go to cashflowchamps.com and you click on our investor portal, then you can have the option. Of course, it's a 506C, and that's the structure that we have there for that deal, and that's working pretty well. We're going to touch on the waterfall and the hurdles a little bit. Again, guys, if you have any questions, just drop those in the chat, and we will answer those as we go, and or at the end of the session, just a reminder there. So waterfalls and promote, right? Let's talk about that. Waterfall are the way that profit flows to the partnership, right? So just think of a waterfall, something like this, right? So what happened is that, think of the waterfall in which the water flows from the top to another level below, at which point it kind of pools and then it flows to the next level below and so on, right? So a real estate waterfall is used to describe how different investors are repaid their investment through the available cash flow that you have for distribution, right? So a waterfall is the very best way to actually model out the terms of your partnership in a spreadsheet. So hurdles, you're going to have hurdles in your waterfall as well. And this is a threshold that can either be preferred return or it can be an IRR hurdle, right? So the IRR hurdle are preferential, like for institutional quality assets, and the project level cash flow really starts at the top of the waterfall and it flows through multiple layers, right? So let's take a look at an example. And so if you have this type of promote structure, which is kind of the one that we are operating from right now. So in this example, you have a 7% preferred return, right? And so you have a 7% preferred return starting out. So up to 7% IRR, there is no promote. You can see that, right? So up to 7%, the investors get this 7% of the cash flow, up to 7%. There's no promote for the operators, right? So there's a 7% preferred obligation to the investors here. So the sponsors get no cash flow until the first 7% return is satisfied for the investors. Now, after you meet that 7%, then what happened, and that's satisfied, after you meet at 7%, then there's more cash flow from the investment than the sponsors is entitled to 30%. So if you have an IRR that is between 7 and 16%, then you will have the sponsors receiving 30% of the promote there, right? And so anything over 16% IRR, then the promote splits at 50-50 between the passive investors and the general partners or the sponsors. So you can see that there's an incentive there for the sponsors or the general partners to do a good job, such that there's a higher level of IRR that the deal is producing, because you're increasing your promote each and every time that the deal performs well. So again, up to 7%, the passive investors or the LP receive all the cash flow. There's no promote for the GP or the sponsors. But once you hit that 7%, and between 7 and 16, then there's a 30% promote, and anything above that 16% IRR, then you have the sponsors are participating in a 50-50 split between the LP and the GP. Let me touch on this last portion here about the investment fee structures. And then I'll just open up for any questions that you may have regarding what we're covering so far. So structuring an apartment syndication deal also involve investment fee structures. And the investment fee structures always give an indication really of the alignment of interest between the sponsors and the investors, right? So traditional private equity structure, it normally has an acquisition fee, it has an asset management fee, it has a preferred return and a promote, right? We touched on some of those terms before, but even this traditional structure can have a malalignment of interest between the GP and the LP. So you have to be aware of these things and kind of know what type of structure is going in place to compensate for something like this, right? So most multifamily deals are structured where there is a 1 to 2% acquisition fee, or maybe a 1 to 2% ongoing asset management fee that you're going to get from the effective gross income. And the sponsors will have a promote which will allow the sponsor to receive a percentage of the profit above the preferred return. We just touched on those. So that's a traditional structure. But just let's take a quick look at how the GP and the LP can be malaligned, and therefore we have to make remedy for this in the deal structure. So it's all about structuring. right? So suppose we have a big value add project, and as sponsors, the project is successfully executed, right? You get in there, you execute your business plan, you do exactly what you need to do. You did your renovations, you did your project, you did your rent increases, and things are going well. Now the property is stabilized and things are looking good, right? What's going to happen there? Well, obviously, you're going to have a big value add to the project, right? So in other words, the valuation of the property is going to be tremendously increased. Now, this is going to create a large, what we call a paper promote, that can only be realized on the sale of the property, right? So if there's little ongoing cash flow, like these yield-starved environment is presenting to us, if there's very little ongoing cash flow above the preferred return, then the GP will have just a little bit of money coming in, meaning that if you already given out a 7% preferred return and the property is just giving an 8% cash and cash return, there's not a whole lot there to go to share with the GP. But here you are, the GP just executed their business plan. The plan is working efficiently. Rent increases has been bumped, rent has been bumped, and so your NOI has gone up and your valuation is skyrocketed. Sometimes these operators are sitting on millions of dollars, but it's paper money, right? They can't really spend it. It's tied up in the property. So what do you think is going to happen? Well, the sponsor will very likely want to sell the asset in order for them to recoup their money, right? They just don't want to collect a few dollars every month, you know, sometimes no dollars every month, and have all that money sit into the deal, right? So sometimes these deals are very good for the LP because they're receiving a nice cash flow and they are anticipating a good upside in the long run. But they sometimes don't want to sell these assets because, you know, the cash flow is good, the property is working properly. They want to sit on the constant cash flow coming in. So that's where the malalignment of interest comes in, wherein the operators really don't have any ongoing cash flow. The LP has some cash flow. The operator has all their money tied up in the deal. They want their money, and the LP want to have this deal constantly just give them cash flow on a monthly basis, right? So the malalignment there, you must have a solution for that, and it's good to kind of take that into consideration when you're structuring your deal kind of upfront, right? So what are some of the solutions for this malalignment of interest between the LP and the GP? Well, one solution could be that you could lower the preferred return, and what that does is that allows the sponsors or the LP to receive better cash flow during the whole period, right? So that's one possible solution for that. Another thing that can be done is what's called promote crystallization, right? So what happens here is that both the LP and the GP mutually agree upon a valuation of the property. You know, they can get an appraiser out there and they can get a property appraised. They can get a valuation that they both agree on. And what you can do from there, you can just reallocate the equity ownership between the LP and the GP, where you're kind of bringing up the GP share of the equity in line with the share of the proceeds that they would realize if the deal was to sell, right? So when you do that reallocation of equity, where the GP is now getting more equity in the deal, then you just crystallize it right there, or like you freeze it right there. And then going forward, you do away with a preferred return, and then you have a straight split between the LP and the GP based on what you agreed on. So, you know, when you're structuring your deal, if you want to hold on to these deals for a long time, and you get in with an operator that's going to do a heavy lift or something like that, these are just some things that you got to take into consideration when you're kind of structuring your deal. All right. So that's pretty much going to do it for today here. 25 minutes after 11, I'm going to leave about 5 minutes or so in case anybody have any questions, anything like that regarding this presentation here today. But let me take a look at the chat. Again, you know, you guys feel free to sign up for the Saturday workshop if you want to do that, or also if you have interest into the Cash Flow Champs Aristocrat Coaching Program, let me know that. Yeah, so Hugo is asking, can you please explain how the profits at the time of sale are distributed? Yeah, is it also a 70-30 split? That's correct. Yeah, so whatever, that is correct. It would still be a 70-30 split if that was the agreement up front. So that would still be the 70-30 split all the way through. So you still meet that preferred return if that is met. If the preferred return was not met during the whole period, like there was always a deficiency, there was not enough cash flow, then that 7%, whatever is accumulated or accrued at the end that's owed to that investor, they will receive that first given to them, at sale, to make sure that is made whole. And then what's left over will be split 70-30 between the LP and the GP. It's a good question. I want to thank you guys for continuing to support us. Spread the word about these webinars. Spoke to a couple of people this week, and they're very excited about what they're hearing, what they're learning. And also just know that we have investment opportunities for you as well. Reach out to us. We'd like to build substantive relationships with you. You can know what's going on. So, join our Facebook page as well. If you go to, you can also schedule a call with us. You can see the QR code on the screen. Just like to keep in touch with you as we go along. We're very excited about the deal from yesterday. We also have more deals coming in the near future. So if you didn't get a chance to be in on that one, we have more for you. All right, we're going to leave it there for today. Again, thank you for coming, guys. Really appreciate it, each and every one of you. Again, spread the word about Cash Flow Champs and what we're doing here. I know the word is getting out regarding these webinars, and people are benefited from it. So we appreciate that. And thank you so much. And catch you next week. Next week, we have a great topic. I think Prashant Kumar will be presenting next week. So please show up for that, and you'll receive some more value there. All right. Thank you. Have a great day. Take care now.